good day to everyone. Today, I want to talk about Introduction to Accounting in Chapter 5 in subtopic Depreciation. Hoyaki Enterprise has the following non-current asset as at 1st January 2014. The non-current asset is fixtures, machinery, motor vehicle and office equipment. All these non-current assets we call as existing asset. Now, let's see on the rate given. On the net book value, we have to use reducing balance method to find the depreciation for non-current asset. And for on cost, we have to use straight line method to find the depreciation for non-current asset. The following non-current assets were purchased and paid by checks for the year ended 31st December 2014. The non-current asset is machinery, motor vehicle and fixtures. These all non-current assets we call as new asset because Hoyaki Enterprise purchased on 31st December 2014. A. Show the calculation of the depreciation for each of the assets for the year ended 31st December 2014. Depreciation is a reduction in the value of an asset over time due in particular to where. We have to calculate the existing asset first. For the machinery, depreciation is 10% on net book value using reducing balance method. The net book value was given is on the 1st January. So you have to find the depreciation for 1 year because it ends at 31st December 2014. The cost that given on 1st January is 110,000 and the accumulated depreciation is 98,000 and net book value is 12,000. To find for 1 year for the cost, you have to take the previous from net book value. First, 12,000 times 10%, you will get 1,200 for depreciation. Next, for the purchase, you have to take from previous net book value and times with depreciation rate to get depreciation and so on. For this, you just have to find for the 1 year. For the motor vehicle, the depreciation rate is 20% on cost. It means you have to use straight line method. Firstly, the depreciation rate 20% times with the cost 250,000. So you will get the depreciation which is 50,000. Next, for the fixtures, the depreciation rate is 5% on net book value. It means we have to use reducing balance method same like the machinery. First, the depreciation rate 5% times the cost that take from the previous net book value which is 40,000 and you will get 2,000 for depreciation and so on. Next, let's calculate the depreciation for new asset. For new asset, we have to calculate from the date of purchase that given. For the machinery, the depreciation rate that give is 10% on net book value. So, we have to use reducing balance method. Date of purchase for machinery is start on 1st March 2014. For the cost, 60,000 plus 1,200 equals 61,200. 1,200 you will get from the transportation. First, to get depreciation, you have to calculate 10% times 61,200 times 10 months per 12 months. Why we have to times 10 months per 12 months is because the date of purchase is start from 1st March 2014. Next, for the depreciation is 10% times the previous net book value, which is 56,100, and you will get 5,610 for the depreciation, and so on. For the motor vehicle, the depreciation rate that give is 20% on cost. So, we have to use straight line method. Date of purchase for motor vehicle is start on 1st June 2014. For the cost, 8,000 plus 2,400 plus 600 equal 83,000. 2,400 you will get from the insurance on purchase and 600 from transportation. For the straight line method, we just use same cost, which is 83,000. First, to get the depreciation, we have to calculate 20% times 83,000 times 7 months per 12 months. We have to times 7 months per 12 months is because the date of purchase is start from 1st June 2014. Next, for the depreciation is 20% times 83,000 from cost, and you will get 60,600 for the depreciation. Next, for the fixtures, the depreciation rate that give is 5% on net book value. So we have to use reducing balance method. Date of purchase for fixture is start on 1st September 2014. For the cost, 25,000 plus 2,500 plus 1,000 you will get 28,500. 2,500 you will get from transportation, and 1,000 you will get from installation. First, to get depreciation, you have to calculate 5% times 28,500 times 4 months per 12 months. Why we have to times 4 months per 12 months is because the date of purchase is start from 1st September 2014. B. Prepare the statement of profit or loss for the financial year ended 31st December 2014. For the SOPL, we need to add both depreciation for existing asset and new asset, and then just total it. For the depreciation for machinery is 6,300, and the depreciation for motor vehicle is 59,683 and 33. For depreciation of fixtures is 2,475, and the total is 68,458 and 33. C. Prepare the statement of financial position as at 31st December 2014. For the SOFP, we need to total the cost, accumulated depreciation and net book value for both existing asset and new asset. For the fixtures, the cost is 68,500, and for the accumulated depreciation is 47,475, and the net book value is 66,025. For the machinery, the cost is 73,200. Accumulated depreciation is 104,300, and the net book value is 66,900. For the motor vehicle, the cost is 333,000. Accumulated depreciation is 259,000 and 683,033. And for the net book value is 123,316 and 67. And total for non-current asset is 474,700, and total for accumulated depreciation is 411,458 and 33, and total for net book value is 256,241 and 67. So that's all from me for this tutorial. If you have any question, you can directly email or DM me. Thank you for watching this video, and don't forget to like it and subscribe. Bye everyone.